Hey, what's up guys? This is the Smart Money Technician and welcome to yet another video. Now, in today's video, this is going to be one of the most important videos that we're going to have in this channel because it is literally the main thing that we're trading in our concepts. It is the foundation to all the trades that we are taking because this is the key component in the trading strategy that is a part of the concepts discussed in this PDF. Now, before we continue, as usual, to read the risk disclaimer. This is not guaranteed. You can see here it says Institutional FX Boss. That used to be the old name that I used to use. But now I am the Smart Money Technician. And we are going to go into the video. So we can just quickly recap. In the previous lesson we showed how we could use the market structure shift from a lower time frame to be able to find an entry when we see that liquidity has been taken. In this case, buy side liquidity was taken and we break structure to the downside on the lower time frame. We form a fair value gap. Price then returns back to the fair value gap, which is our entry point. We will enter, we'll place our stop loss above the high, and we will look to ride price, anticipating that it is going to reverse, right? So we go back to the previous one. Here, over here, we can see that the sell side liquidity was taken on a higher time frame. Then we go to the lower time frame. We wait for the swing high to get taken. It gets taken. It forms a fair value gap. Price returns back into the fair value gap where we look to buy. We place our stop loss below the low prior to the break of structure when price takes this high out, right? And then we anticipate that price will go to the upside, as you can see. So in today's video, we are going to be discussing SMT Divergence. Now, SMT stands for Smart Money Technique or Smart Money Tool. And we basically use it to measure the strength that the market does have, right? Whether it has strength to the upside or whether it has strength to the downside. It's basically used to see how strong or weak the particular asset that we're trading is, right? So in saying this, the way this works is that we have assets that are closely correlated. Now, what does closely correlated mean? Closely correlated means that the assets that we are watching move in the same direction, right? They move in tandem, meaning, for example, we have NASDAQ, we can have S&P 500, and we can have Dow Jones. Or we could even have Euro USD, GBP USD, and dollar index. But dollar index really moves the opposite direction. So let's say, for example, we have S&P 500, right, going up. We would also expect NASDAQ to go up. We would also expect Dow Jones to go up, right? Because they move in the same direction, right? Now, there are times that the market does move in the opposite direction when they're completely out of sync, and those are low probability times, which you shouldn't really be looking to trade at that time. Trade during the time that they are moving the same direction, because those times are really like very, very predictable and much more easier markets to navigate. Okay, so over here we have what we said closely correlated, meaning that they move in the exact same direction as one another. If NASDAQ is going up, SP 500 will be going up, Dow Jones will be going up. If Dow Jones is going down, SP 500 will be going down, NASDAQ will be going down as well, right? So that is very simple to understand, right? Now, there is another case where we call it inversely correlated, meaning that they move in the opposite direction. And this is the case, as I said earlier, for dollar index. dollar index moves the opposite direction as Euro USD and GBP USD. You understand? Euro USD and GBP USD, they both move in the same direction, but they move the opposite direction as dollar index. I hope this is not too much information. Just rewind the video, listen very closely to what I said, write it down if it helps, so that you can just understand, because I'm not saying anything that is too complicated at the moment, right? So over here in the chart, how does this help us, right? Before I move to that picture, I just want you to visualize something. If I said that NASDAQ, SP 500, and Dow Jones are all moving in the same direction, right? What does that mean? It means that when NASDAQ is, let's say for example, NASDAQ is trading lower and it makes a lower low, right? We would also expect that SMT 500 will make a lower low. We would also expect that Dow Jones would make a lower low. But there are situations, right, that take place. Let's get to the picture where, for example, as you can see here, we're trading higher, we're trading higher. Also here, we're trading higher, we're trading higher. If you can't see this, right, this is basically NASDAQ is trading higher. And then we compare this to Dow Jones or US 30. It's also trading higher, right? So as it was trading lower here, right, NASDAQ or US 100 was also trading lower here as well, right? This low over here in S&P 500, that low gets taken right there, right? As you can see, it gets taken right here. But in NASDAQ, it doesn't do that at all. It fails to take out this low, the exact same low here, right? That, my friends, is what we call SMT divergence, right? So it is what we see as a crack in correlation. These markets are supposed to be correlated, where we are supposed to also see that this low should get taken, but it doesn't. It cracks the correlation that it's supposed to follow, right? So this is a sign of a reversal in the market. Whenever we see SMT divergence, that's when a light bulb in your mind is supposed to go, because now you are expecting that the market might reverse, okay? Now, this can actually get very deep, but we're going to try to keep it as basic as possible so that we don't sound too complicated, right? So, as you can see over here, we have SMT divergence, right? And basically, this is the earlier charts that I showed you where we have price take the buy side liquidity. But the thing is, how do we know that price is going to take this buy side liquidity and reverse? The first thing we know is that we had that entry pattern that we taught in the previous lesson. But the sure way that we know that price is going to reverse is if we have SMT divergence. This is the most important confirmation that we have, that we know that price will reverse after taking out the buy side liquidity, right? So over here we can see that we have NASDAQ or US 100, right? And we have Dow Jones or what they call US 30 in this broker over here, right? And you can see that here we were trading down, right? Same thing for US 30, we're trading down. Why? Because they're correlated. So as we were trading up in NASDAQ, right, or US 100, we trade up to the point that we take out the buy side liquidity over here, right? But over here in US 30, we fail to take out that high. SMT divergence again, where we have a higher high over here, but a lower high over here. This is the confirmation that we need to have when we know that the price is going to reverse after taking out the buy side liquidity. SMT divergence, right? So if you don't understand, you can always ask questions in the comment section, right? And basically, I just want to show you some actual chart examples, because you might think that this is some cherry-picked example, and I can assure you it's not if you go and look for it your own self in the chart. It's always there. The market will always do this whenever it wants to reverse. It's just that many people are unable to see it, so you need to train yourself to be able to see it in order for you to be able to capitalize on it. So even this week, we had multiple SMT divergence at the time of this recording, the week that we had prior to this recording, and I'll show you them.